So hello and yeah, good afternoon in my case here from Berlin, Germany. Probably good morning or good evening, wherever you listen to this webinar or the recording. My name is Jens Klatt, and we want to have a look at the markets and what to expect in the upcoming trading week, especially not. I have to add right here, not necessarily only the next trading week, but probably also what we should expect then for around 1.5 hours from now for the non-farm payrolls, which will be published here. The U.S. employment situation, very, very interesting data set. This is mainly due to the fact that currently in the dot plot or respectively the last Fed rate decision has shown that there's a slight touch right now to a second rate hike in 2018 here in the second half of 2018. This said means nothing more than if the data now disappoints, there's a good chance that most of the gains of the US dollar, which it has seen here in the last 2 trading weeks, will be sold again, and this could lead to some significant volatility. But before we start, first of all, and as usual, we wanna and we have to have a look here at the risk disclaimer. Please be informed that trading with financial instruments offered by Admiral Markets, CFDs, ETFs, stocks carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into any agreement or transaction, please read the terms and conditions of the service from Admiral Markets. Please consult a specialist if necessary to ensure that you understand the risks involved in trading. And investors should study carefully the so-called key information documents, or KID, in order to understand the nature, risks, costs, potential gains, and losses of margin products offered by Admiral. If you are interested in getting this key information document, just reach out to Admiral and send them a mail to support to their support team to make sure that you have a good starting point if you plan to download the demo then at the website from Admiral. So then there's something which Admiral is in fact famous for, offering one of the most competitive Dax spreads with a typical spread, in fact, of 0.8 points during the main trading hours. Very interesting right now during the month of July, and based on the fact that the Dax turned 30 this week, at the beginning of this week, Admiral decided to lower the spread here to 0.5 points. You can find all information on the website, and as I already said, you usually have to have a closer look at the offering from Admiral, since this is one of the most competitive, if not the most competitive offering in terms of the DAX and the DAX spread. Then there will be a very important change for Forex and CFD trading, the so-called ESMA, with the leverage restriction for retail clients, which will go into effect officially on the 1st of August. But the implementation of the new regulations here by Admiral is scheduled for Monday, the 30th of July already. So this is still 3 weeks from now, around 3 weeks. But nevertheless, please make sure that you check your current positions, and if you have to make adaptations to current positions or in terms of your trading strategy, and also contact is not only around the leverage restriction, but it's also possible that you can recategorize yourself as a professional client if certain criteria is met here. And the interesting thing about this is that, for example, when you recategorize yourself, let yourself recategorize as a professional client, then, for example, negative balance protection is not given anymore. In case of Admiral, there's a great opportunity. So, by the way, so if you recategorize as a professional, you have no leverage restriction, so everything stays the same. The only problem then is that many clients fear that there's no negative balance protection either. And this is great in terms of Admiral, because they offer this negative balance protection here according to their policy up to 50,000 GBP. Also here, contact Admiral for further infos on this. And here are the contact details. So phone, mail, and I suggest, by the way, giving a click here also on YouTube. Subscribe to their YouTube channel, because then you will see all recordings here with no big problems, and you will get informed once a video is uploaded there. This is me. And now let's have, first of all, look here at the agenda for today. So what we question ourselves today: what are the key economic events in the coming trading week? I want to answer this. Then what's the current bias in the FX, equity, and commodity markets? So especially for today, probably there will be a news event guiding the price action of the next trading week then. Which news events I'm talking about here? I already said it at the beginning of this webinar. It's the non-farm payrolls. It's one of the, if not the most volatile news event which you can find out there when trading, especially the FX markets. Let's see whether probably we'll also get to see some volatility here in the equity markets, in the Dax, which we want to have a look at a little later then, or in a few seconds, in fact. And then also we want to answer the question, which trading opportunities may arise, not necessarily only next week, but also probably today, because it's not only the non-farm payrolls which are interesting, but there's also the Canadian employment situation, which will be made a topic. And in fact, the US dollar, Canadian dollar, broke out on the upside to new yearly highs already around 2 weeks ago, and it's currently retesting the breakout level. So with those two data sets coming out today, there's a good chance that probably we find a long trigger here and then taking off from there. But before we have a look here at the developments in dollar, Canadian dollar, first of all, here to look at the Dax birthday, and you get the anniversary gift on the website. Please have a look here. You can see the typical spread then. By the way, these times are Eastern European time. So in my case, I have to go 1 hour back. Then it means 9 to 5:30. This is usually the Xetra trading hours. This is when the main trading volume comes into the market, even though the future DAX, for example, at the Eurex trades between 8 to 22, so 10 p.m. German time then. And let's now have a look here at the current situation, what we find in the DAX. It's in fact a very interesting spot, and we want to start here with the DAX. After yesterday, probably some bulls came into the market and started to cheer up. I wasn't really sure about this, and currently it seems as if the DAX can hold those gains from yesterday. Let's have a look here at the 5-minute chart intraday, so that you just have an idea of what I'm talking about. So yesterday there was, let's zoom a little into this. Yesterday there was this push here right at the opening, where the DAX gained enormously, then gave back some of these gains into the afternoon and around the market opening of the US equity markets, lost some of those gains again, retested a very interesting region around 430 to 450, pushed slightly below that. Nevertheless, we can consider this the breakout level. I'll show you what I'm talking about here on the hourly chart in a few seconds, and then made it back here towards, not above, but towards 12,480 points, and today opened higher around and above 12,500 points. Nevertheless, weren't capable of making it above that level, but in fact turned lower right from the start of the trading day. Now let's zoom in again. Turned lower here, and now the question is, in which direction will the non-farm payrolls probably push us, or will they have any effect on the DAX at all? I'd like to make it in a very rough way. So I'd say if the data disappoints, I think that the DAX has probably some bearishness to fear, and there's a good chance that we push towards the lows. I'm sorry, not the lows, but this region around 12,400 points again on the downside. Even though from a pure fundamental perspective, I'd currently be a little I'm a little skeptical. I want to show you here why I suspect the equity markets to go lower from a worse than expected NFP data set that has yeah, it's difficult, in fact, to say, because I'm not even sure whether equity markets will be affected in any way. But it's just a gut feeling, I'd say. So I think if data disappoints, that is more of interest for the FX markets here, especially the US dollar, but probably the DAX will also show some kind of reaction, which again is then more likely to be on the downside. But let's have a look at this a little later. First of all, let's focus here on the technical side, and let me just explain to you what I was just talking about. Breakout level around 12,430 to 450 I was talking about, and then the retest. So that's exactly what you can see here. So I zoomed out of the chart, and this is the hourly chart. What you can see here is the DAX obviously consolidating and building, yeah, kind of a range, let's say. And we traded within that range for at least the last trading week of June, and then also at the beginning of this trading week, there was an attempt to break this region here on the downside on Monday, 12,100, 130 points, and then we took off from there again and pushed against these highs. We didn't make it above that. It was shortly before Independence Day on Wednesday, so that was here on Tuesday. And then yesterday we took off and broke above that level. You can see it here. There was some dynamic coming into the market. You can zoom into the chart. You will see that the candles look quite bullish, let's put it. So I can see it here. And then there was this retest of this breakout region. And then we took off from there again. So from this technical perspective, currently the overall picture seems to be bullish. But, and this is the thing, if you zoom out aggressively, you can see here these lows, former lows, which were broken on the 21st of June here. We retested it and then sold off sharply, quite aggressively against this region, 12,550 to 12,600 points. That was a very important support. In fact, you can spot it here also in this region. So this red line is the region around those lows here from the end of May, respectively, then from the first 3 weeks of trading in June, and could be considered a very important support region. We broke below that level, and what we know is that the quite significant support becomes afterwards a resistance line or resistance zone, and this is exactly what happened here, obviously, after it broke lower. And now the interesting thing is that we're pushing towards this region again and failed to make it above that level. So I think, by the way, if we make it above 12,600 points, for whatever reason, it could be because the non-farm payroll surprise on the upside, for example. I don't know. But for whatever reason, if we make it above 12,600 points, there's a good chance that there's further upside momentum given towards 12,700 to 750 points. And that's definitely something to keep in mind here. If we can make it above these highs, even though the first reaction here shows that there is some sellers coming into this region, and the DAX obviously currently has not the momentum on the downside, and there's not enough demand here to let us push back above 12,600 points. But in fact, currently we failed. In the morning we failed already. So now you can also see why I'm talking about 12,400 points. If the NFPs disappoint, I could imagine the DAX push towards this region, and if it does, in fact, and also falls below that level, it could mean that this is the start of probably another test then in the upcoming trading week of this lower range here, and the region around 12,100 to 12,130 points on the downside. So it could be that this then was only a fake out. And by the way, I have to admit, I still do not know what was the reason for this push higher in the DAX. So there were several questions from clients at my end, from traders I usually talk to on the social media channels and all this, and said, hey, what's the reason for the DAX pushing higher here? Yesterday in the morning, I said, I don't know. The only thing I see is that there's obviously more demand than there's supply, and that's why the market pushes higher. And I was definitely right with this one, but I have no clue what was the reason, the main driver for this. It could be that it was only because of thinning out liquidity here, and that this is then putting this whole move here on the upside on a very, very unstable ground, because if it was only because there was more demand than supply and it was a thinned out market environment, the sustainability of such a move should be questioned no matter what. And this is something where the non-farm payrolls become interesting, because again, if they come in lower than expected, I would imagine markets to really say, okay, that's not a good sign. That's also, by the way, true because now more and more U.S. equity markets come to life, and especially from 3:30 onwards. And have a look here at the Dow Jones in this case. So what you can see in case of the Dow Jones is that we fell below the 200 simple moving average, and we never made it back above that level again. So I'm not saying that we are about to see an attack at this region here around 24,000 points and push below that level and close below that level this trading week. But if the non-farm payrolls disappoint, there is at least a chance that we'll see at least another test of this region, and we definitely do not make it back above the 200 simple moving average. And this is due to the fact that all in all, the interpretation of a weak data set here around the non-farm payrolls is, that such a data set probably indicates that the Fed hikes or keeps on hiking rates into a not that solid or not that strong economic environment. And this could then rather sooner or later result in some kind of recession which forms at the market, and probably the break below the 200 simple moving average after nearly 2 years, which happened here. Last time we traded below the this blue line, in this case, this simple moving average 200 here, was around the Brexit in 2016 in June. So the market traded above that, and usually what you can say is this at least, not at least, but it's a pre-indication that probably the momentum, the Dow Jones in this case, is losing its momentum here. And there's other things, other reasons which are showing that probably the outlook for the overall US economy starts to show signs of weakness, let's say. And therefore, I'd like to go again here to where is it? Here. That's the first one. So this is a tweet. Oh, I'm sorry. That wasn't good. 1 second. So this is a journalist from Reuters, and I wanted to show you this. Click again. There we go. So what does it show? It's the yield differential between 2- and 10-year US Treasury notes. So that means this is the difference. You say, okay, for 2 years, you're currently getting something like, I don't know, 2.8%. That means you're buying a bond 2 years duration, you get 2.8% per annum, so per year. And then you have a 10-year yield, which is meaning you're buying this bond here, and you're getting 3% currently, which is already, well, probably resulting in some kind of skepticism at your end right now, because you say, wow, just 2 years, I get 2.8, and my money, I give whatever amount, let's say 10,000 euros, and I get 2.8, and for 10 years, I get 3%. Why should I buy 3 years, a 10-year bond then? I could get nearly the same yield here when only giving away my money for 2 years. And this is exactly the point. From a rational perspective, there must be something wrong. Let's say wrong is probably a difficult word here, but there's something happening right now in the U.S. economy. Why is that the U.S. 10-year U.S. 10-year yield curve is flattening that aggressively? So currently showing a difference here of only, in this case, 0.3%. Why is that? And the reason for that is because the Fed is currently hiking rates, which is pushing short-term yields higher. So in fact, you can see here, if they hike in September a third time in 2018, what you will see is that this is probably then the point where this yield differential will invert. You will get more for giving away your money on a shorter period of time than you'll give when giving away 10 years in this case. So shorter period means 2 years. And so the reason for short-term yields to rise is because the Fed is hiking rates currently. while the market participants are obviously very skeptical around the overall economic outlook for the US economy for a longer time frame. So in the future, obviously, or for the future, those market participants do not expect the Fed to hike rates that aggressive anymore. And why? Because they doubt that there will be any positive economic momentum, but it's more likely that there's probably a recession forming on the horizon. So with this said, it's very interesting that we can say, okay, this is probably not the best economic outlook. And now imagine the following. Currently, there are strong signs of such a recession forming, and also short-term yields are rising because the Fed is expected to hike rates. And into such a market environment, imagine what would happen if now, even though it's only one data set, but the non-farm payrolls being published today, that this data set in this case will then disappoint. So that probably accelerates the skepticism and is definitely a potential sign of weakness for the overall economy and also for companies, which would more likely to result in equities coming lower. In this case, we are only talking about US economy, respectively US companies in this case, and the Dow Jones. But this usually, this should have side effects, negative side effects on European equities too. And that's the how to say that. This is the more detailed reason why I think that the non-farm payrolls have to come out better than expected to at least stabilize the to stabilize here the current situation in the equity markets. If they disappoint, chances are high that the equity markets will push lower, starting with US equities here, and meaning that in this case, the Dow Jones, for example, shouldn't make it back above this blue line, the 200 simple moving average. And the same is true then for the DAX, which should usually be expected to push lower and probably at least test the region around 12,400 points. So this is it around the equity markets and the situation around the non-farm payrolls. By the way, if you want to double check what to expect, I somehow urge you to say to check the website from admiralmarkets.com here and to check here the education and there the analytics. The education is for the webinars and which webinars to expect then in the upcoming days. But here it's analytics and there the Forex Calendar. I've already opened it here, and there you can also see it's not only the non-farm payrolls. What to expect here is currently the forecast is 195,000. So in fact, and this is mainly due to the fact that I expect I hope for volatility, and I expect this volatility to come into the markets if the data set comes significantly below that number. So that's why I think, or I hope for. That's not I think, but I hope that the numbers will disappoint, coming in somewhere around, let's say, 160,000. If they come in there, then again, there's good chances to see volatility, not only in the US dollar, we'll have a look at this in a few seconds, but also in the equity markets then, and in this case, then seeing momentum on the downside in the Dow Jones. So you can also see that there's another data set today. It's the Canadian dollar, and it's the same situation. It's the employment change, which will be published here. And now things are getting interesting because what I just said here around the non-farm payrolls and my hope that numbers will disappoint is something which is not that positive when it comes to the US dollar, Canadian dollar here on the daily chart. So I think this is already a very interesting picture, which, by the way, we already presented several times in the past, because this formation here is forming now for several weeks, in fact. And what you can see is that obviously we had a very strong resistance line here, this red line, this lower red line, which is around 131 plus minus. And this was a strong resistance line, and there was serious supply coming into this level here, pushing dollar Canadian dollar lower. And nevertheless, you could see that there was kind of a sequence of higher highs and higher lows forming here from those lows from those April lows in this case. And then the breakout occurred here, and now if you work with such kind of this kind rising wedge, or it's not a rising wedge, that's wrong. It's an ascending triangle. I think this is a better way to put it, because obviously it's not a wedge, but it's a triangle. You can say that you can project here a target on the upside, which is bringing us out at, let's say, something like 139 to 140 around on the upside. I mean, this is not an intraday target. We're talking about several weeks here that the market will probably trend towards this region, but I think it's a good target here on the upside. Nevertheless, after the breakout occurred, and now with this retest of this region, of the breakout region, which is around 131, the thing is, now what we need is a reason to buy US dollar and to sell the Canadian dollar. And from a pure fundamental perspective, what you need here is, you need a good data set around the non-farm payrolls, and you need a bad data set from the Canadian economy. And with what I just said, it's such a momentum driver on the upside, let's call it, or buyers coming in here, that would usually result, if the NFPs come in weak, and then you need a weaker data set around the employment situation in Canada. Not sure if this will really happen, because what we definitely know is that there is at least some kind of momentum in the Canadian economy. The latest data sets just pointed this out. But if the data set from Canada disappoints, Canadian dollar here is definitely worth watching, especially true if the non-farm payrolls, if I'm completely mistaken, if I'm completely wrong, and the non-farm payrolls from the US come in better than expected, because this is then definitely a good potential driver here for another push higher in the upcoming week, which will at least let us retest the region around 133.70 to 134, and probably if we make it above that level, there is then further momentum to be expected, which could rather sooner than later in the upcoming weeks to months push us as high as 139 to 140 in dollar Canadian dollar. So dollar Canadian dollar is definitely very interesting to watch right now. And by the way, don't be too dependent here on the news which are released today, because even if they disappoint, and probably the dollar Canadian dollar can make it here long against this level, let's say, so turn bullish from here, but probably dips a little lower, whatever. Everything what's trading above 127.50 to 128 should be considered dollar Canadian dollar bullish, in my opinion. So I think that even if this data set is not the trigger which is driving dollar Canadian dollar higher from here, it doesn't necessarily mean that things turn sour, let's say, from here, but probably it only takes a little longer. All in all, the sequence of higher highs and higher lows can be clearly seen here. And by the way, probably this is a pre-indication on what to expect for WTI. So we made WTI also a topic over the last weeks, and some of you may recall that here we've seen the OPEC deciding that the oil production should be increased by, in fact, only something like 600,000 barrel per day. Interesting enough about this is that the market obviously expected way more. So this corrective move, we made this already topic, this trend which developed here was mainly driven by this sharp decline in the oil output here, due to the fact that oil fell significantly lower from, I think it was 2014 onwards. And so now they changed this, and usually you would say, especially when looking at the latest data around the commitment of traders report, I presented here last week, the week before, I'm not sure, you usually say, okay, the combination is usually the reason why I should expect WTI go lower from here, but instead WTI shot higher the day of the OPEC. That was here on the 21st of, 22nd of June. Yes, it's 2 weeks from today ago. And not only that, but pushed higher over the last trading week here too, and to new yearly highs, in fact. And that was surprising to some or the other, even though you could easily explain this by saying, well, obviously market participants expected the oil production to be extended even more than only by 600,000 here, what just was presented. But the thing is that things didn't change that much, I think, and there's a good reason, especially after the tweet from Donald Trump over the last weekend when he called the King of Saudi Arabia, where both agreed, that was something he tweeted, that both agreed that oil prices are too high. The thing is that this is usually a sign that probably there are some forces now coming into play which are interested to push WTI lower. And why do I say all this? Well, what we know is that WTI and Canadian dollar are usually positively correlated to each other. In case of dollar Canadian dollar, obviously there's a negative correlation. So usually you would expect dollar Canadian dollar, if it rises, meaning that Canadian dollar devalues, WTI to come lower too, and the other way around, vice versa. The interesting thing now is, if you paint a picture which is seeing dollar Canadian dollar forthrighting the sequence of higher highs and higher lows and going from 139 to 140 over the upcoming months, this is usually a sign of Canadian dollar weakness, and that way potentially, and we can already see that, by the way. So dollar Canadian dollar started to devalue right from the let's say from the beginning of the year. Let's say so from February onwards. That was here around when we really started. That was when we started to push higher and build the sequence, while WTI pushed higher. So first it lost some ground too, but pushed higher in the interim here. And the interesting thing about this is now, probably the devaluation of the Canadian dollar taking place against the US dollar currently is a pre-indication of WTI seeing a sharper downtrend to form here rather sooner than later. So I think that it's definitely worth to not only look at the dollar Canadian dollar, not necessarily only today because of the non-farm payrolls from the US and also the Canadian dollar, or the Canadian employment situation being a topic here, but also in the upcoming days, weeks, months probably, that probably WTI will also see a more significant push lower. Probably that was only a last push higher, now may being stopped out here on the upside, and probably will start rather sooner or later to form a downtrend from here. Even though before we now become overly bearish, the trend is upwards. That means we are long, and we're long as we trade, in case of the daily chart here for WTI, we're long as we trade above 63.50. And everything above that is anti-cyclical, even though some of you probably might start to wonder if there's probably something like a bigger corrective move around the corner. And again, dollar Canadian dollar is probably worth watching here, because this is usually potential pre-indication. And currently there's divergence forming, which could lead to the divergence being reversed rather sooner or later. And I see this reversion happening from WTI prices coming lower instead of Canadian dollar starting sharply to rise. Also because one of the main trading partners of the Canadian economy is the US. And if the US is about to see a recession at the horizon, that's something to be skeptical about whether the Canadian dollar can really see significant capital inflows within the next months, years in this case. So that's it around the commodities, respectively dollar Canadian dollar. Let's focus now on Euro USD. Also very interesting formation currently forming, and I have to say that I'm really happy, because we haven't broken this thin red line here before the non-farm payrolls, region around 117 to 117.30 around, but it's close. It's really close here currently, and I consider this to be our trigger level. That means if data comes in below expectation, but also if data comes in as expected around the non-farm payrolls, so again 195,000, but for example average hourly earnings disappoint, coming in at 0.1 instead of 0.3 or so, this is a good potential driver for bearishness in the US dollar. And it could be that with making it above 1730 in Euro USD, there's then further room on the upside region about 118 here. So definitely worth watching. Also Euro USD, and especially if the data disappoints. There's no data coming out for the euro right now, so the main driver will be the non-farm payrolls. And again, the main region here will be this region around 117.30. And as you can see here also, it's not only that you can see quite strong resistance line here, resulting out of the fact that this is the current region around the weekly highs, but also the highs here from last week, the region around, again, 117.20 here, but also that we found support after then, or thanks to the ECB, we broke below that support quite dynamically here. That was here. That now, obviously, this former support turned resistance and probably now turns support again if we break above that level. So, and also here, something really interesting happening. See again, we see some heavy supply coming in. We push lower from 117 down to 115. We push again to this region, but the supply coming in from the upside diminishes with every attack taking place here, which is usually a sign that probably there will be more likely a break on the upside than we will see a turn lower from here. And the trigger event today, again, non-farm payrolls. It's now around 1 hour from now, and things are heating up, let's say. And again, if the data disappoints, coming in below 195, I probably say 160 minimum. If probably we come in at 180, still this is within the consensus range. Nevertheless, the thing is that here other data sets, again, like, oh, by the way, this is not a given 3 red here. Let us put it that way then. Let me just, okay, let's have a look at all those data coming out then, and let's see. Friday, Halifax in an hour. So these data sets will be published here. There are the average hourly earnings, especially those here, month on month, 0.3. This is the number I was referring to. If this number comes in below expectation, even if the number of the employment situation here, the non-farm payrolls, come in as expected, probably coming in at 200,000. If this number around average hourly earnings disappoints, this is usually a potential trigger for US dollar bearishness into the weekly close. So very, very interesting to watch this. And by the way, when talking about the US dollar, usually, or first of all, when talking about the euro here in this case, usually also have a look in this case at GBP USD. This is due to the fact that we have a strong positive correlation. So what I show you now is the Admiral Supreme tool here. This is an add-on you can get. By the way, what do I look for? Correlation matrix. This is what we want to have. So this is something you'll get for free here, and which in this case shows you the correlation between Euro USD and GBP USD here on a 4-hour chart, for example. We can also say the daily chart. Then you see the correlation is strongly positive. If you click on this, it's German now, but nevertheless, there's a strong positive correlation between those two, meaning if one goes up, the other should be expected to go up as well. Meaning if I see Euro USD bullish, well, you should usually expect GBP USD to be bullish too. And this is the interesting thing now. We are about to, even though we have a sequence, in this case in the daily chart, of falling highs and falling lows, but we are probably about to see at least an attempt here to make it back above 133 to 133.30, which would then interrupt, if not break, the sequence of falling highs and falling lows here in a pound sterling on the daily chart. And this is also something which should be expected and could be expected once the data around the non-farm payrolls disappoint. If not, probably we'll see another push lower. The thing is that most of positive data set around the non-farm payrolls is already priced in. So potentially, US dollar is about to see a lose-lose situation. So you can already spot between the lines when I'm talking about the non-farm payrolls. Obviously, I'm very, very skeptical. Even if the numbers come in above expectation, I don't see a positive impact on the US dollar. And that has to do with the fact that the Fed, within their statement from the 13th of June here, and that was, by the way, yesterday, the minutes were released, was underlined there again. There was a slight shift towards a second rate hike, slightly now above 50%, meaning that the members in the Fed board now, with a small majority voted for a second rate hike then in 2018. So not only in September, but also in December, or not only in December, but also in September, however you put it. The thing is that if the data set now disappoints, this would be priced out again. It was priced in. That was what that drove, in this case, not only GBP USD lower here, as you can see, but I'm sorry, here that was on the 14th then, respectively. Was not only the 14th, that was the trigger with the ECB especially. But you can see that obviously the market started to lose after this statement, and now it's mainly an all priced in, meaning if the data now disappoints, it would be priced out again, and this could then result in a sharp rise, not only again in Euro USD, but also in Pound USD, even though I'd favor, based on the chart or the technical picture here, I'd favor Euro about above GBP, Pound Sterling. But when talking about not only the Euro, you have to talk about the GBP, but you have also, when talking about the US dollar, talk about gold. Gold is also very interesting. Have a look here. Same is true for gold. So there were several, especially here, 2 days. There was a small delay, let's say, but then there was a sharp decline from which gold lost some serious ground here from the 15th of June. That is 3 weeks ago, and gold was driven significantly lower. And the thing is that I am from midterm perspective, I'm very positive for gold. I think that gold has a serious chance, rather sooner or later, to attack the region around 360 to 365 here on the upside. And now the thing is, especially when looking again, therefore have a look here at this chart, especially when the yield curve flattens that aggressively as it currently does, and showing signs of a recession forming at the horizon. This is usually a market environment within which you expect gold to perform well, and it completely doesn't. And this is probably something I'd call a mispricing to some extent, meaning if the data now coming in, non-farm payrolls coming in and coming in above expectation, I'm sorry, not above, below expectation, I could imagine gold to really take off from here. So even though the picture on the daily chart definitely is not positive, as long as we trade below this level here, which is around 1,305 to 1,308 USD, nevertheless, there's a good potential that there's at least a rebound to be expected if the data disappoints here, which will push us as high as 1,280. And this is, by the way, also something I imagine to be possible today if data disappoints aggressively enough, let's say. But to find a good trading setup, I think we should definitely go down to the hourly chart in this case, and then you can see that I'd consider long engagements with a push above 1,259 to 260 here. That's probably very interesting. And you don't want to be long anymore if we push back above, below 1,251. But with this setup here, going long with a break above that level and a stop, so let's say 1,259, and the stop up here 1,251, I think it could be a very interesting setup also from a risk reward perspective, because if we make it above that level and run another 20 USD from here with a stop of only in this case 8 USD, the risk reward is 1 to 2.5, which is very interesting and very attractive, I think. So there's several markets to definitely watch for around 45 minutes from now with one non-farm payrolls. So Euro USD, GBP USD, gold, but also equities probably becoming interesting if data disappoints, especially if data disappoints. And even if data is not disappointing, I consider chances to be given that probably nevertheless US dollar will probably sell off, because most of as expected data set, let's say, is already priced in. And yeah, so in fact, that's it from my end here. I hope that you enjoyed this format, and I'd really appreciate if you join again next week then on Monday. Whoop, there we go. As I already said, here's the education page and there's the webinars. So from then Monday onwards, it's not only you, by the way, but there's also real-time daily trading ideas with several of the Admiral team here, the Admiral equipe, giving their insights and ideas around the markets. And nevertheless, we'll have the pleasure then on Monday at, in this case, 6 p.m. German time here with the open range breakout, the trading setup we will formulate. And next week, then on the 11th, Wednesday, at 4 p.m. German time, we'll stress test this trading setup here, which we will formulate here in a real market environment. And yeah, I'd really appreciate if you join me there. And that's it from my end. So have a nice weekend and happy trading. Watch your stops. Good luck with the NFPs. And talk to you on Monday then again. See you soon. Enjoy yourself and bye-bye.